In this video, I'm going to show you two energy stocks that can quietly pay you high-yield income for years, even decades, while most investors are distracted chasing hype. These are businesses designed to generate massive cash flow, return capital consistently, and compound wealth over time if you understand how they actually work. The companies operate at the center of the global energy system. They control critical infrastructure, move billions of dollars in product every single day, and benefit from long-term demand that is not going away anytime soon. These are not speculative plays, they're cash machines built to last. Let's start with the first stock, Marathon Petroleum, ticker MPC. To understand why this business matters, you have to think beyond just oil prices. Most people look at energy stocks and immediately think of commodity volatility, unpredictable cycles, and risk. But Marathon Petroleum is not just an oil company, it is one of the largest refining and midstream operators in North America, and that changes everything. This company sits in the middle of the energy value chain. It takes crude oil and turns it into usable products like gasoline, diesel, and jet fuel. Then through its midstream operations, it transports, stores, and distributes those products across a massive network. That positioning gives it something extremely valuable: control. Marathon Petroleum is not just exposed to the price of oil. It profits from the spread between crude oil and refined products, which is often referred to as the crack spread. When demand for refined products is strong, margins can expand significantly, even if crude prices fluctuate. This creates a more stable and predictable cash flow profile compared to companies that rely purely on upstream production. Now layer in the scale of this business. Marathon Petroleum operates one of the largest refining systems in the United States. Its network includes multiple refineries with the capacity to process millions of barrels per day. That scale allows it to optimize operations, reduce costs, and maintain efficiency across different market conditions. And then there is the midstream segment. Through its ownership stake in MPLX, Marathon Petroleum has exposure to pipelines, storage facilities, and logistics infrastructure that generate steady, fee-based income. This part of the business is less sensitive to commodity price swings and provides a reliable foundation of cash flow. This is where the high-yield story starts to come into focus, because when you combine refining margins with midstream stability, you get a business that can generate significant free cash flow across different market environments. And that cash flow has to go somewhere. A large portion of it goes back to shareholders. Marathon Petroleum has been aggressive in returning capital through dividends and share repurchases. The company's dividend yield has remained attractive, supported by strong earnings and consistent cash generation. But the real story is not just the yield. It is the sustainability of that yield. This is not a company stretching to pay dividends. This is a company generating excess cash and choosing to return it to investors. That is a critical difference. Now let's talk about what is driving this cash flow. Demand for refined products remains strong. Despite the push toward renewable energy, the world still relies heavily on gasoline, diesel, and other petroleum-based fuels. Transportation, aviation, and industrial activity all depend on these products. That demand is not disappearing overnight. In fact, in many regions, it continues to grow. Marathon Petroleum is positioned to benefit from that ongoing demand, especially as global supply dynamics tighten and refining capacity becomes more valuable. Another important factor is operational efficiency. The company has been focused on improving its refining margins, optimizing its asset base, and reducing costs. These efforts translate directly into higher profitability and stronger cash flow, and when you combine that with disciplined capital allocation, you start to see why this business can support high-yield payouts over the long term. Now let's look at the financial strength. Marathon Petroleum has demonstrated strong earnings performance, driven by favorable refining margins and steady midstream contributions. Its balance sheet remains solid, giving it the flexibility to invest in the business while continuing to return capital to shareholders. This balance is important, because a company that can both grow and pay investors is far more valuable than one that has to choose between the two. There is also a strategic element here. Marathon Petroleum is not standing still. It continues to evaluate opportunities to optimize its portfolio, improve efficiency, and enhance shareholder returns. This includes refining operations, midstream assets, and capital allocation strategies. That ongoing optimization helps ensure that the business remains competitive over time. Now let's address the long-term relevance. Energy demand is evolving, but it is not disappearing. Even as renewable energy grows, traditional fuels will continue to play a significant role in the global economy for years to come. Infrastructure like refineries and pipelines cannot be replaced overnight. That creates a durable demand base for companies like Marathon Petroleum. And durability is exactly what you want when you are looking for income investments. You want a business that can generate cash flow not just today, but consistently over time. That is what supports dividends. That is what creates compounding. Now let's talk about why this stock stands out in the current market. While many investors chase growth stories, income-generating businesses often get overlooked. But in an environment where consistent cash flow matters, these companies can quietly outperform. Marathon Petroleum offers a combination of yield, stability, and operational strength that is difficult to replicate. It is not about explosive growth, it is about reliable returns, and for long-term investors, that can be even more powerful. Now, no investment is without risk. Refining margins can fluctuate, economic conditions can impact demand, regulatory changes can affect operations, but the company's scale, diversification, and operational focus help mitigate these risks. The key takeaway is this: Marathon Petroleum is not just an energy stock, it is a cash flow machine with a built-in mechanism to return that cash to investors, and that is exactly what makes it attractive for long-term income. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move to the second stock, and this one plays a very different but equally important role in the energy ecosystem. 𝗗𝗟𝗏, ticker OKE. If Marathon Petroleum is about refining crude oil into usable products, 𝗗𝗟𝗏 is about moving and processing natural gas and natural gas liquids across the United States energy network. And that distinction matters more than most investors realize. Because natural gas is not just another commodity, it is the backbone of electricity generation, industrial production, and increasingly, the infrastructure powering data centers and AI-driven computing. As energy demand rises globally, natural gas continues to play a critical role as a reliable, scalable, and relatively cleaner transitional fuel. 𝗗𝗟𝗏 sits right in the middle of that system. This company operates one of the largest integrated midstream networks in North America. It gathers natural gas from production basins, processes it into usable components, and transports it through a vast pipeline system to end markets. That positioning gives 𝗗𝗟𝗏 something very powerful: predictability. Unlike upstream producers that are exposed to volatile commodity prices, 𝗗𝗟𝗏 generates the majority of its revenue from fee-based contracts. That means it earns money based on volume and usage, not directly on the price of natural gas. This creates a more stable and recurring revenue stream. And stability is exactly what income-focused investors are looking for. Now let's talk about scale. 𝗗𝗟𝗏's infrastructure spans thousands of miles of pipelines, processing plants, and storage facilities. This network is essential to keeping energy flowing across regions where demand is constantly shifting. Every time natural gas is produced, it needs to be gathered, processed, and transported. 𝗗𝗟𝗏 is involved in multiple stages of that chain, which increases its control over the flow of energy. That control translates into pricing power. Because when you own critical infrastructure with limited alternatives, customers rely on you. And when customers rely on you, you can generate consistent cash flow through long-term contracts. Now here is where the high-yield story becomes important. 𝗗𝗟𝗏 is known for its strong dividend profile. The company generates significant distributable cash flow, which it returns to shareholders through regular dividend payments. But what makes this especially interesting is the underlying business model. Midstream infrastructure tends to be less sensitive to short-term economic cycles. Even when commodity prices fluctuate, energy still needs to be transported, homes still need heating, power plants still need fuel, industrial facilities still need feedstock. That creates a baseline level of demand that is remarkably resilient, and 𝗗𝗟𝗏 benefits directly from that resilience. Now let's talk about growth. 𝗗𝗟𝗏 is not just maintaining its existing infrastructure, it is actively expanding through acquisitions and organic development projects. These expansions increase throughput capacity, extend geographic reach, and strengthen its position in key energy corridors. Every new pipeline or processing facility adds to its long-term earnings power. And because these assets are long-lived, they can generate cash flow for decades once built. That is the foundation of a compounding dividend business. Now let's bring in financial performance. 𝗗𝗟𝗏 has demonstrated strong cash flow generation supported by its fee-based model. Its distributable cash flow provides coverage for dividends while also allowing for reinvestment into growth projects. This balance between income and expansion is critical, because a company that only pays dividends without growing eventually stagnates. But a company that can grow while paying dividends can compound value over time. That is the profile 𝗗𝗟𝗏 is building. There is also a structural tailwind supporting the business. As domestic energy production continues, especially from shale basins, the need for midstream infrastructure increases. Every new production source requires transportation and processing, and 𝗗𝗟𝗏 is strategically positioned in several of the most important energy regions in the United States. That means growth in production often translates into growth in demand for 𝗗𝗟𝗏 services. This creates a natural alignment between industry expansion and company revenue. Now let's talk about why this stock is particularly relevant in today's environment. Energy security has become a major global theme. Countries are prioritizing stable energy supply chains, and natural gas is playing a central role in that transition. It is flexible, it is scalable, and it is essential for grid stability. 𝗗𝗧 benefits directly from that macro trend, because no matter how energy evolves, infrastructure remains necessary, and companies that control that infrastructure tend to generate long-term value. That is the essence of the 𝗗𝗧 story. Not speculation, not hype, but essential infrastructure with durable demand. Now, like any investment, there are risks. Regulatory changes, project delays, and shifts in energy policy can impact growth. Commodity cycles can indirectly influence volumes, but the fee-based structure helps cushion much of that volatility. And over time, infrastructure-driven businesses tend to smooth out those cycles through long-term contracts and diversified assets. So when you step back and evaluate 𝗗𝗧, you are looking at a company that sits at the center of energy transportation in North America, with strong cash flow, a reliable dividend, and a growing asset base. That combination is what income investors look for, and when combined with Marathon Petroleum, you start to see a broader picture. Two different companies, two different parts of the energy system, but one shared theme: consistent cash generation and long-term income potential. Now before we move into the final section, here is something important. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. When you put these two companies side by side, Marathon Petroleum, ticker MPC, and 𝗗𝗧, ticker 𝗗𝗚, you start to see a very clear picture of what high-yield investing in energy actually looks like in 2026. It is not about chasing the highest dividend number you can find. It is about understanding where the cash flow comes from, how stable it is, and whether it can continue being generated through different market cycles. Because in energy, cycles will always exist. Prices will go up and down, demand will shift, policy will evolve. But infrastructure does not disappear, and companies that sit at the center of that infrastructure tend to quietly generate wealth over long periods of time. Marathon Petroleum represents the downstream side of that system. It takes raw crude oil and turns it into the refined products that keep transportation, aviation, and industry moving. Its earnings are driven by refining margins, operational efficiency, and the scale of its integrated network. When conditions are right, it produces significant free cash flow, and that cash flow supports strong capital returns to shareholders. At the same time, 𝗗𝗧 represents the midstream backbone of natural gas. It does not rely on oil prices or short-term commodity swings in the same way upstream producers do. Instead, it earns stable, fee-based revenue by moving, processing, and storing natural gas and natural gas liquids across a vast infrastructure network. Together, these two companies represent two critical layers of the energy economy. One transforms raw resources into usable fuel. The other ensures that energy moves efficiently from production sites to where it is needed most. And both are built on a foundation of real physical infrastructure that cannot be easily replaced or replicated. That is what gives them long-term relevance. Now let's step back and think about what this means for investors. Most people approach the energy sector with short-term thinking. They react to oil prices. They try to time cycles. They jump in and out based on headlines. But income-focused energy investing works differently. It is about owning businesses that consistently generate excess cash regardless of short-term noise. It is about collecting dividends while the underlying infrastructure continues to operate and expand. And it is about patience, because the real power of these types of investments is not in 1 year of returns. It is in compounding over time. Reinvested dividends, gradually increasing payouts, operational improvements, and steady demand that does not vanish overnight. That is how wealth builds quietly in the background while most investors are looking elsewhere. Now, there is another important angle here. Energy demand is not declining globally, it is evolving. Even with rapid growth in renewables, the world still depends heavily on oil and natural gas. Transportation systems, industrial production, and electricity generation all require stable energy inputs. And until alternatives can fully replace that demand at scale, companies like MPC and 𝗗𝗚 remain essential. That does not mean there is no transition happening. It means the transition takes time. And during that time, infrastructure owners continue to generate cash. Now let's bring this back to the core idea of this video. High yield does not mean high risk if the underlying business is strong. The key is understanding where the yield comes from. In these two cases, it comes from real assets, long-lived infrastructure, and essential services that the economy cannot function without. That is what makes them different from speculative income plays. And that is what makes them worth paying attention to. So the question you should be asking yourself is not just whether these stocks pay a strong dividend today. It is whether they can continue generating the cash flow needed to support those dividends 10 years from now. Because if the answer is yes, then you are not just investing for income, you are investing for durability. Now I want to hear your thoughts. Between Marathon Petroleum and 𝗗𝗟𝗧, which business do you think has the stronger long-term advantage in a changing energy world, refining or natural gas infrastructure? If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.